Palisade Radio is brought to you by First Majestic Silver Corp, one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. On the show with us today is returning guest Frank Holmes. Frank is the CEO and Chief Investment Officer of U.S. Global Funds. There's also an award-winning blog that's read by 40,000 people, including myself, each and every week in 170 countries around the world, which can be found at usfunds.com. Frank, welcome to the program.
It's great to be here, especially on a casual day Friday, and gold is up $25.
Yeah, it's really been exciting the last 3 months. I got so used to for the last 4 years that you'd get beaten up for 7 or 8 days in a row for one good day, and it seems like a complete reversal. I guess the thing that we should start off with here, Frank, is you're very invested in the mining and metals sector. Do you think gold's made a bottom? Or maybe that's an obvious question at this point, but what's 2016 going to look like?
Well, if you go back in the history books and you look at the past 30 years, the average decline, and what is the percentage of that decline, it's almost a case study, perfect bottom, December the 15th, 17th. That gold fell for 4 years. It fell 44%. The average cycle drops 45%. It's perfect. And now we have the first leg of this rally coming out of it. And most people are in denial of it. But bullion usually has a run for the next couple of years. And it won't be straight up, but it usually appreciates 70%.
Wow, that's fantastic. Well, let's talk about gold versus the gold stocks. You've always maintained that there's a place in everyone's portfolio, call it insurance for the physical metal. You're very good at talking about different weightings and how to allocate properly, to the metals, but there's also a place for the mining stocks. And over the last 4.5 years, when we had a bad decline in the metals, the mining stocks, by some metrics, were actually in the worst bear market they've been in the last 90 years. And now we've just seen this huge rubber band effect, which has propelled them upwards. What do you think we're going to see in the mining stocks as opposed to the metals themselves?
Well, I think that you're going to get this ratio again where gold stocks are moving 2 to 3% for every 1% move in bullion. I think that that's in motion again because many of these companies have repaired their balance sheet. They've refinanced, they've streamlined their organizations. And I think that they're much more disciplined on the way they spend money on the allocation of capital. And this, by the way, happened in the airline industry, just a waste of capital. And the stewards today, the CEOs and boards, are much more paranoid about capital destruction.
Very good. Well, I think that you deserve quite a bit of credit. One of the most important things is when you're in a bear market and you're in a sector to pick the best, most stable, stocks that do not decline like the rest of the sector. And you've been talking about the royalty companies. The royalty companies, as compared to, call it, the majors like Barrick and Newmont, held up very well over the last 4 years. And now, as you'll discuss in a moment, they've seen pretty strong gains coming out of this bear market.
You know, what's a real shocker is that in the past 5 years, Franco Nevada has doubled, and the average big cap gold stocks off 50%. They were up 70, and now they're clawing their way back. So no, the royalty model is a superior business model. And yes, Franco Nevada, it just gets a nice royalty on most of the assets in Nevada that are produced by both Barrick and Newmont. So a safer bet is to buy the royalty company. And in fact, that was the first deal I ever took public as a young broker back in 1982, was Franco Nevada. And before merging with Newmont in 2001, it enjoyed, even in a falling gold market, it grew at a 36% CAGR, a compounded annual growth rate.
That's fantastic. And the upfront, the idea of a royalty company, for those that don't know, is to put an upfront capital expenditure into either development or mine construction for a guaranteed offtake over time at a set gold price. In terms of what we're going to see over the next few years, do you think that these royalty companies will outperform the majors, or since the majors were so damaged, are they going to potentially be the better place for investor money?
I just think it's a safer bet when we look at the revenue per employee. Look at Newmont. It's about $300,000 of revenue per employee. You look at Goldman Sachs, it's over $1 million of revenue per employee. And when you look at Franco Nevada, it's $15 million per employee. I mean, they have so much more margin, and they're frugal. And Silver Wheaton's another company that Randy Smallwood was in our offices this week, and they're doing about $600 million in cash flow with 30 employees. That's $20 million of revenue per employee. That is a great model. Now, what's really important for the listeners is versus a gold loan is a gold loan gets paid off over 10 years or 5 years, and that's it. When you get a royalty, you get it forever. So if future discoveries are made 20 years from now, 50 years from now, these gold mining companies, these gold royalty companies get a royalty off of everything.
Yeah, it's certainly a powerful business model. Before the call, we were discussing some companies that you're also interested in. One that's very exciting for me to hear was Endeavor Mining. It's a company that we wrote up at Palisade Research a couple months ago. We wrote it up again last month, and the stock has been performing quite well. They acquired True Gold just about a month and a half ago. Frank, talk to me about Endeavor and any other, call it mid-tier mining companies that you're interested in right now.
Well, there's a couple of companies that we think will be taken out the way Claude Resources was taken out. And there's been several acquisitions this past year, higher grade, small cap companies that in particular, the higher grade. And Klondex is one of the other ones that's listed on Toronto that has an asset in Nevada. Franco Nevada has a royalty on that particular company, so it gives it the good housekeeping seal, good quality management, and it's very high grade. So when we look at our models, it's worth $8 to $9 trading under $5. The other one is Endeavor. Endeavor, at one time before it became a gold focus on gold mining, I was a chairman of Endeavor, so I know the company very well. Neil Woodyear's done a phenomenal job of building out that asset base. And one of they call the smart beta, or the factors we use to screen stocks, is who has the highest cash flow return on their capital. So we look at all the gold stocks, and what's really interesting is Endeavor shows up in the top 20 highest cash flow returns on invested capital. And so with that, we think that's one of these other companies, as they get further along developing the most recent operations, that they get up to 900,000 ounces of gold. As they de-risk the mine development, they become more and more attractive to be taken out. So I think that Endeavor will be taken out. I think that Klondex will be taken out.
Frank, many gold bugs are so focused on gold and the doom and gloom of every other sector in the world that they end up investing their entire portfolio in the sector. Right now, that's certainly something that would pay off the last 3 months. But the 4 years before that, it probably would have been quite detrimental to one's portfolio. You have always been a proponent of proper balancing in a portfolio. You're not just invested in precious metals and mining stocks. In fact, what we'll talk about later is you launched an ETF last year called JETS. I want to transition a bit to the general markets. There's a lot of fear and concern about the Dow Jones and the U.S. equities starting to top out. The Fed is maybe starting to get concerned internally that they've lost control. What do you think is going to happen in 2016, 2017 with the general equity market?
Well, I think that the profit cycle has peaked and it's been declining, and everyone's resetting what their expectations are. What's going to be important is that the world now are negative interest rates, and they're trying to spur this global economic activity. And I think that in an election year, there's not much going to happen. But I don't think there's anything that's been really pervasively negative in the capital markets. I think that the cash cows is where money is going to go, where there's steady eddy cash coming in, able to increase their dividend, buying back their stock. I would say services or products that people need. And that's one of the reasons why I created the JETS ETF. You need to fly to get across America. It's too long, and business is about speed and alacrity. And so right now we look at there's 2 million people flying a day in America. And with oil falling, these companies are huge cash cows. You're witnessing 88% increase in dividends last year, and they still traded at 7 times earnings. But when companies like Branson's company, Atlantic, it was taken over. Excuse me 1 second. It was taken over at a 47% premium. So I think that you're going to see more acquisitions and more money going into a re-rating of that particular industry where it's a cash cow.
Well, since you've started the JETS ETF, I don't have my numbers exact, but I think you're over $60 million in assets under management. The airline sector has performed quite well since you started JETS, and there's been a lot of profitability in the sector. Playing devil's advocate here, we were just talking about the royalty companies performing so well because there's few employees for how much profit's coming in. The airline business by design, has to have thousands and thousands of employees and lots of equipment, lots of logistics in place. Does any of that concern you?
Always, especially when it's unionized and you get into those frictions. But coming back, it's a need. And I think that industry is going to go through a re-rating. What's happened is that so often people like to quote Warren Buffett that he lost a lot of money in the airlines industry. So he's gone to private jets and net jets. But I think it's very different because the CEOs, like the CEO of American Airlines, he said, don't pay me in cash, pay me in stock. And they're buying back billions of dollars worth of stock and they're increasing the dividend. So we have several CEOs of these airlines that are now taking back stock in lieu of cash. I remember that being the technology industry with Steve Jobs and Oracle. I think those particular companies had spectacular performance because management really believed in the companies.
You were speaking about cash cows as we transitioned into the JETS ETF. Can you name some ideas of either sectors or individual stocks you're looking at that are not metals and mining related?
I think that Microsoft is a massive cash cow. Its whole model of getting you to subscribe, its methodology of getting revenue is only ballooning its cash. By billions every month is $1 billion going into the bank account. I mean, it's an incredible piece of machinery. And they've been increasing their dividend, paying dividends. And it's become a need. Everyone has Microsoft to run the global economy and to run our domestic economy.
Well, Frank, we began with gold. Palisade Radio is very focused on the resource sector, so I want to come back to gold. What should investors be looking for in terms of pitfalls? Do you think there's anything at this point that could derail what seems to be a very new, very strong new trend that's developed, not just in the precious metals, but in quite a few of the commodities as a whole?
Well, the big factor is when you look at gold, there are two demand drivers, the fear trade and the love trade. And the love trade is an important component, and it relates to the rising GDP of China, India, affectionately known as Chindia, which is 40% of the world's population that buy gold for love and for gift giving, for weddings, for graduation, etc. So that's an important component. And then there's the fear trade, and the fear trade is what's dominating the marketplace today. And that is whenever there's negative real interest rates, whatever the government pays you on a 10-year government bond, take away the monthly CPI number, and you either get a positive rate of return or a negative. If we go back to September of 2011, the 10-year government bond was minus 3%. You were locked in a 3% loss every year for 10 years. Quietly, and it was invisible because Fed funds was zero, rates went positive by 200 basis points and the dollar ripped. What's happening this year? It's gone negative because of the fear of global trade, in particular in an election year. So I think the government's going to do everything to stimulate economic prosperity. And this is good for gold in particular because it's coming from negative rates.
All right, Frank. Well, thank you very much. I just want to say I'm very jealous and envious of that background you've got behind you there. It's a beautiful setup and nice lighting. I'm thinking I might need to set something up like that myself here.
Great.
Well, once again, Frank Holmes is the CEO and Chief Investment Officer of U.S. Global Funds. All of our listeners can visit usfunds.com. Sign up for Frank Talk, which is Frank's blog he's posting each and every week. Join the 40,000 other readers who are finding great content there. Frank, thank you for coming on the show.
Thank you, and have a wonderful weekend.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?